I am going to go through my presentation here today where I'm going to show you my idea on how to learn how to trade like a casino. Now, as we go through this today, I'm not going to be pitching anything to you. In fact, I'm going to be giving something away for free here at the end of this. And really my purpose here today is just to provide some education and some information that hopefully you'll be able to incorporate into your day-to-day trading. So again, hang on to the end. I'm going to be giving you something for free here today. But again, like I said, there will be no selling going on here. I just really want to spend this time on a Saturday providing you with a little bit of education. So this is me, just as by way of a quick introduction. This was me back in 1987 when I graduated from high school in Odessa, Texas. In fact, I graduated from the high school that did the Friday Night Lights book, right? This was the year just before I graduated, the year before the book was written about the high school that I went to. That was me a few years later, a couple years later after graduation. I went through the U.S. Navy boot camp, and that was me. While I was in the Navy, I held a top secret security clearance and was designated as our recruit chief petty officer during boot camp, which means I got to be the leader of the lowest of the low, right? And so sort of funny, but that was me in 1988, and this was me a few months ago and at my office. And this is, again, as Renee mentioned, I was the VP of a 300-seat call center. I founded the Oil Trading Group back in 2010, and I've been trading. I traded a few years before we founded the Oil Trading Group. We have participated twice weekly on a Squawk radio show over at Top Step Trader. Don't do that as much right now, but that's something that we have done in the past, providing information and education to that group of traders over there. And right now we have 200 plus active trade room members on a day in and day out basis. All right, so here are the discussion points today. Like I said, there's not going to be a big sales pitch at the end of this. I'm just going to give you some information. So hopefully you'll be able to learn a few things here today. What I'm going to talk to you about today is day trading considered gambling. And as we all know, as we've been to a cocktail party or a holiday gathering, and you tell people for the first time that you're an active day trader, and they always ask you, well, isn't that gambling? Well, we're going to talk about that today. We're going to talk about a trading edge, how to define it, and what one looks like. We're going to talk about how I'm going to show you how a 35% win rate is better than a 60% win rate. And so you're probably already going, wait, what? We're going to talk about just quickly the Holy Grail, and then again, the OTG or Oil Trading Group success formula. So let's get into it here. Is day trading considered gambling, right? So in order to get the idea of what day trading actually, or what gambling is, we all kind of have to agree on a definition, right? And so if you do a quick search at the on Google and the word gamble, then the Merriam-Webster definition comes in. And it says to play a game for money or property, or to bet on an uncertain outcome. That is the definition of gamble, right? And so if that is the definition of gamble, that actually is the definition of trading, right? You're playing a game, so to speak, for money or property, and you are betting on an uncertain outcome. So again, according to Webster's dictionary, yes, trading is a type of gambling. So what we've done here at the Oil Trading Group, so instead of running away from that, right, and you've all been asked that at the cocktail party or your holiday party or by some friend or family that you haven't seen in a while when they're asking what you're doing these days, they always want to know that. And that's kind of an awkward feeling, right, when somebody asks you that. What is the definition of gambling? And really, no, I'm not gambling. I'm statistically doing this and that. But it's really hard to explain in a way that makes sense for people. So what we've adapted, or what I've adapted over the years, instead of running away from that, we try to run to that. And again, yes, it is a form of gambling. However, the main difference between gambling and trading is when you are gambling at a casino, the casino controls the statistical advantage. As traders, we can control our statistical advantage, right? So that is the difference. When you're gambling, you have no control over the advantage. And when you are trading, you do have control over the advantage. So here's the casino's advantage explained. What you're looking at here is a simple North American roulette wheel, right? And so what you'll notice is that there are, on this wheel, there are 18 black squares, there are 18 red squares and there are 2 green squares, right? The 0 and the double 0. So with that being said, there are 38 chances to win. So if you are at the casino and you want to bet on a red square or a black square, then you have 18 chances to win, right? But if it lands on one of the, let's say you're going to place your wager that it ends on a black, then you have 18 red squares plus the 2 green squares that will cause you to lose if it lands on one of those squares. So your chances to win are 18 divided by 38, which is 47.3%. That's your odds. The casino, however, has 20 chances to win, right? They have the 18 red squares, you bet on black, and then they have the 2 additional green squares or green tiles to land on. That gives them an advantage of 52.7% on every spin of the wheel. So the casino's advantage is 52.7 minus the 47.3%, or a 5.4% advantage. And so for every $100 bet in the casino, they win $5.40. And for every $1 million that is bet on the casino, it's $54,000. So as you know, it doesn't take long to rack up that kind of money in a casino when you're talking about dozens of roulette tables and it's open 24 hours a day, 7 days a week, right? And so it doesn't take long to see exactly how the casino makes all the money that they make. And this is just one table game that you have the opportunity to play. So again, that's the casino's advantage explained. Let's take a look here and talk about a trading test. I always like to do this. So what I want you to do is identify which trade here will win and which one will lose. So trade number 1 is a winner or a loser, and trade number 2 is a winner or a loser, right? But what we don't know as traders is the difference between a winning trade and a losing trade until it actually either hits our stop or our target. So theoretically, it's a 50-50 chance of winning, right? Well, not so fast. When you bet at a casino, you risk $1 to make $1. Your odds are lower, but when you bet $1 and you win $1. However, because of emotions, traders typically tend to lose more when they lose than when they win. And so as a result, what appears to be a 1-to-1 reward to risk ratio is actually much worse. So what I'm going to show you here, we are the oil trading group, right? And we trade oil. We also trade the ES. But what I'm going to show you here today can be applicable to any instrument or any idea that you trade, right? And so one of the popular things out there when you go to the internet, and one of the popular ideas is about taking a trade off. Let's say you get into a position and you're trading 2 lots. You take one off at X number of ticks and then you let the other one run, right? And so a trader entering two lots on a trade, when the trade goes in their favor, they take one lot off at 10 ticks and they let the other lot run. Now, this is something that occurs in the CL specifically. And again, you can apply your own instrument to this information. But for example, on the CL, as an example, when I talk to people about trading, I'll often talk to them about how it is that they manage their trades. And so I always get, well, Jason, I like to take one off at X number of ticks, and on the CL that typically ends up being 10 ticks, which is $100. And I let the other one run because I'm in profit and I'm safe. So when I ask them, and I've had this conversation hundreds of times over the years, when I ask them what is the average amount of time or average that second lot goes off. And so the answer I usually get goes something like this. It's, well, you know what? I've never really tracked it, so I don't know. And so we'll sit down together and we'll go through a bunch of their statistics. And what we sit down and realize is that while a lot of traders do it in different ways, so for example, one trader may have a 12-tick initial stop. They hit that first 10-tick stop. They hit that first 10-tick target. They move their stop from 12 ticks down to 9 ticks. And so the first trade goes off at $100 and the other one goes off at -9 or $90. And so that's truly a break-even trade. Some traders go immediately to break even. Some traders will take that second contract off at a 2-to-1. Some traders let it go 10 ticks and pull back to 5 ticks and they take it out there. There's any infinite number of ways to manage that second lot. But what I have discovered over the course of doing this for a long time and having these conversations with traders is that the average ticks of the second lot goes off at about 6 ticks or $60. So your first trade goes off at $100 profit, and the secondary trade goes off on average of $60. All right, so when a trade wins, the trader wins $160. That's one lot times 10 ticks, $100 on the CL. And that's one lot times 6 ticks or $60 on the CL. Now, here's the question I always ask. Where is your stop? So when you get into a trade, and we all need to have stops, where is your stop on the CL? And so I hear all sorts of different answers, right? Some guys say, well, the CL is so volatile and so active that I like to have a 20-tick stop, or I'll put it up above the recent swing high, and maybe that's 17 ticks. And so again, when you have all of these conversations with people, what I have determined is that the average stop on the CL is somewhere between 12 to 15 to 17 ticks. So for the sake of this discussion, we're going to use 2 lots at 12 ticks. Now, one question I always ask, and the answer is always no. But the question I always ask is, do you take one off at 6 ticks and let the other one run to 12 ticks? Meaning, are you getting out early like you do your winners? Are you getting out of those winners early like you do? And the answer is invariably no. Most people do not scale out when they're losing. They take the full stop. So in essence, what they are doing is letting the losing trades run and cutting the winners short, which is exactly the opposite of what you want to do as a successful trader, right? You want to maximize your rewards and minimize your risk. But most often that paradigm is shifted from, I'm going to cut my winning trades short, take one off at 10. I'm going to let the losing trades run, take both off at the full stop. So when a trader wins in this scenario, he wins $160. And again, if the stop loss is an average of 12 ticks per contract, or $120 times 2 lots, then the stop loss average is $240. So what that simply means is when this trader enters the trade, he is risking $240 to make $160. In other words, for every dollar that's put at risk, he is being rewarded 67 cents. So again, what on the surface appears to be a 50-50 proposition is actually much worse, because this trader is losing more when they lose than wins when he is winning, right? So if you have that 50-50 proposition at the casino where you bet $1, you win $1, it's not like that in trading, because oftentimes we will take bigger losses than we do banking our profits. All right, so continuing on here, what I'm going to show you today is a hard thing to do, okay? What I'm going to show you, and I'm going to give you some statistical analysis, and I'm going to show you that what I'm going to talk to you today, what I'm going to talk to you about today is a hard thing to do. But you know what? Losing weight is hard, stop smoking is hard, and quit drinking. These are all hard things to do. But the health ramifications or complications of being overweight is also hard. Lung cancer from smoking is hard. And the personal and health complications of over drinking is also hard. So finding your edge and trading with it is also hard, but so is blowing out your trading account, because you're losing more when you lose than when you win, right? So if we're going to have to pick a hard, let's pick the hard that is the best for us, right? So if we're going to have to do something hard anyway, let's do the thing that's hard that is the best for us. All right, so Investopedia.com defines a trading edge as a technique, observation, or approach that creates a cash advantage over other market players. It doesn't have to be elaborate to fulfill its purpose, and anything that adds a few points to the winning side of an equation builds an edge that lasts a lifetime. Now, there are 2 ways to have an edge. You can have a setup that's an edge, and it will work for a while. In fact, in the early days of the oil trading group, our edge was a particular setup. And that setup was an opening range trade, breakout type trade. And so basically the 4 1-minute bars that would lead into what was at that point the pit open, or the RTH session, there would be a range that was created around those 4 1-minute bars. 2 ticks above would be a breakout trade, and 2 ticks below would be a breakout trade to the short side. And that worked fantastically. And so on days where the market was really doing well, it would explode, and it would be an easy thing to do, right? You would just sit back and collect your ticks. On the days where the top side failed, then the bottom side, the short side, would oftentimes come back and work for you. And then there were those rare days where you would just get whipped around, but those were rare. For the most part, there was an amazingly strong trading edge built around a particular setup. And then the market changed, and that setup was no longer valid, and the edge was gone. What I'm going to show you today in learning how to trade like a casino, I'm going to show you how your edge will suit you in the long term, regardless of market conditions. All right, so let's talk about Sun Tzu from The Art of War, one of his quotes. He says, victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. So we talk about trading is war. And so again, you've noticed a U.S. Navy background, right? I was in the U.S. Navy, and I talk about trading being a war. And make no mistake about it, it is war, and you need to approach it that way, right? So what Sun Tzu here says is that victorious warriors win first and then go to war, and defeated warriors go to war first and then seek to win. How many of you out there, and you don't have to answer this directly, but just think about this. How many times have you gone through and let's say you've blown out an account, right? You sat down, you bought your laptop, you bought your new training program, you watched a video, you bought a program, and you started to trade, and you're really looking back at it now and didn't really have a good sense of what you were doing. And you didn't really understand what it was that you were doing, and you ended up losing money. Maybe you blew out an account. Maybe you've blown out multiple accounts. I talked to lots of traders who do a lot of those types of things. What you did is you went to war first, and then you figured out how to win, where a victorious warrior, which is why you're here today listening to these presentations, is you're trying to figure out how to win first before you go to war. And oftentimes as traders, we are in this go to war first and then figure out how to win, right? All right, so I'm going to show you what the psychology of a statistical advantage does to you, right? So this is a screenshot from a football game, a college football game between the Michigan State Spartans and the Michigan Wolverines. Now, this is an in-state rival. These two teams play once a year, and it is super important to the alumni of both of these schools. In fact, it's really basically played for bragging rights in the state for the remainder of the year. And typically speaking, over the course of history, the Michigan Wolverines, that team in yellow and blue, has been the better football team historically. And that team in green and white has been the lesser team. Now, in this particular instance, you'll notice down in the bottom right-hand corner that there is a 7 next to Michigan State, and then there is a 12, right, next to Michigan. And what that simply means is that on this particular day, in this particular year, the Michigan State Spartans were the favored team. Now, they are playing at Michigan's home stadium. So they went, in other words, they went on the road to play Michigan at their stadium. Now, if you are a graduate of the Michigan State, that team in white, if you're a graduate of Michigan State, then this is a big deal for you, right? This is going to be your year. This is going to be the year that you're actually going to put down your foe. You are favored to win, even though you're on the road playing at their stadium. Now, as luck would have it, as you get set down on your couch and you're about to ready to watch the game, or you're preparing yourself mentally to watch the game, you got your favorite adult beverage, you've got your chips, your queso, you're ready to watch the game, and your wife, significant other, comes in and says, honey, I need you to do a few things for me today. Now, you're disappointed that you now have a list of honeydews, but what you do is you suck it up and you do it, because we all know, guys, that happy wife is happy life, right? And so you suck it up and you go do it. You hit record because you're going to come back and watch it. This is your game that you want to watch. You hit record and you go out and you start doing your honeydews. And as you're out through the day, you inadvertently hear the score of the game. You know what the outcome is of the game, and you find out that your team wins. And so you're really happy and you're relieved, right? But you still come home and you want to watch the game because this is your team. And now you really want to watch because you know they win, right? And so you sit down in front of the couch and you have your same favorite adult beverage, but the stress of watching the game is gone because you know what the outcome of the game is going to be before you watch it. So at the end of the first quarter, your team's down a touchdown. Then you go into half and your team is still down. You go into the third quarter and your team is down still. But what you say to yourself is, I don't know how it's going to happen, but I know we're going to win and it's going to be really cool. It's going to be fun to watch when it does happen. Now you're into the fourth quarter and you're starting to say, your team's still down. You start to say to yourself, did I see the score right? And you begin to doubt what you know. But you do know that you do feel comfortable that you saw the score right and that your team is going to win. And it gets all the way down. I want you to look at that score at the bottom right-hand corner of the screen. In the last quarter, with 1 second left in the football game, Michigan State recovers a fumbled punt and runs it into the end zone to win. So if you don't understand what the score of the game is going to be, you don't know what the score of the game is going to be, you're stressed out and worried and upset the entire game. In fact, you may wait till 15 seconds left in the game and in disgust, throw your remote down on the couch, turn the TV off, walk away, only to find out that your team won with 1 second left in the game. But because you knew what was going to happen at the end, you stayed with it and you were less stressed out because you knew you were going to win. And so that is the psychology of a statistical advantage, right? So there is the psychology of a statistical advantage. When you have a statistical edge, like the casino, you know the outcome of the game before it happens. So if Susie is in the casino and she wins $25,000 on a progressive slot machine, the casino isn't stressed out. They understand that in the long run, they have an advantage over every player. There are going to be ups and downs, but they have the advantage and they understand what their edge is. And so remember, victorious warriors win first and then go to war. They know their statistical advantage before they go to war. Defeated warriors go to war first and then seek to win. They just trade. They don't have a statistical idea of what there is out there in front of them. They have a statistical advantage. The victorious warriors do. The defeated warriors are just trading, right? And so that is the psychology of a statistical advantage. All right, so what I'm going to show you here today, I'm going to show you a few statistics, and then we're going to do a little bit of math. And so the government obviously wants us to disclose to you that futures and options trading have large potential rewards, but also large potential risk. And you must be aware of these risks and be willing to accept them in order to invest. You should seek appropriate advice from your broker or licensed investment advisor before taking any action. Past performance discussed in here does not guarantee future results. OTG is not a CTA, and given this representation, all information and material provided by us to you is for educational purposes only, and hypothetical or simulated performance results have certain limitations, and you can review the entire disclaimer by copying that link into your browser or typing that link into your browser, and you'll be able to see the entirety of the disclaimer. All right, so remember when I told you what I would show you would be hard? Remember that I told you what I would show you today would be hard. So this is some statistics back in the last quarter of 2017. I'm going to show you an updated version of this here in just a minute. I've done this presentation a few times, but really the point will still be the same. So what you see on here is every day in green was a winning day. Every day in red was a losing day, right? So in August, there was a lot of green. In September, there was some red. In October, more green than red. And in November, there was more red than green, right? So these are winning days and losing days as they occurred in our trading room. Now, here's what's an important thing to note. The total gain and loss here as being displayed is 1,150 ticks, or $11,505. The largest gain was $1,700. The largest loss was $340. The average winning trade was $429. The average losing trade was $196. The win rate here was about 35%, and my lose and break even was about 65%. The average hold time on winning trades was about an hour, and it was about 12 minutes on the losing trades. All right. So here's that same updated idea for the last quarter of last year. Everything in green are wins, everything in red are losses. And again, over that last quarter of this past year, 2018, the statistics are roughly the same. All right. So again, the win rates in the 30s and et cetera, right? And your average win to loss ratio right around 35%, with break evens coming in at around 16 to 17% of the time. Now, the break even, why is the win percentage low? And that would be a question that's normally asked, right? Why is the win percentage low? Well, when the trade is winning, you ride it as long as you can. And when the trade is not winning, you get out as quickly as you can, right? And so when you're getting out as quickly as you can, your win rate's going to be lower. But when you're winning, you want to ride those things as long as you can. And I'm about to show you through what I affectionately call the desktop psychologist. I'm going to show you how a 35% win rate is better mathematically and statistically than a 62% win rate. And the reason that I call this the OTG desktop psychologist is because this is the spreadsheet that we turn to when you're going through those inevitable periods of drawdown. All right, so let's go back here. Let me grab this spreadsheet out for you here. And so let me tell you a little bit about how this spreadsheet is designed. It's really a simple tool. What you can do with this is you can play what if scenarios, or you can plug in your actual statistics. And so really, it does not matter what market you trade, whether you trade gold or the ES or the CL or futures market or even currencies. It does not matter the market that you're trading. What matters in here is your reward to risk ratios. And so what this spreadsheet is going to do is you plug in some information, and then it's going to randomly distribute out that information as it may occur randomly in the real world, right? So for example, if you have a strategy or a system that has an 80% win rate, you still may have 20 of those 100 trades, all of those losers may congregate right at the front of your trading system, right? Even though it wins 80% of the time, you may gather in 1 month, you may have all 20 of those losing trades or break-even trades occur right at the front end of your system. And so what this is going to do is give you a random approximation of what your system is going to, how it will be randomly distributed based upon real world type ideas, right? So we all know that if you're going to have a 60% win rate, you don't go 6 wins, 4 losses, 6 wins, 4 losses, 6 wins, 4 losses. You might go 20 losses, 30 wins, right? It may be distributed like that. And that's what this spreadsheet is designed to do. So before we go through it, let's set up some of the default scenarios here. And so in this example, I'm going to give you an initial equity balance of $15,000, right? Some of you are going to have bigger accounts than that. Some of you are going to have smaller accounts than that. But this is going to give you a simple kind of guidepost that we're going to start with a $15,000 trading account in this example. Now, this is going to be a total trials of 100. Simply put, this is going to randomly distribute 100 trades, not based on a system and not based on anything other than the statistics that you've plugged in. So this is not a moving average crossover or some kind of divergence on an oscillator or something like that. This is simply just saying we're going to randomly distribute 100 trades based upon the data and risk parameters that you plug in. All right. The risk per trial in this instance is I'm going to use that example that I used earlier, right? Where you take one off at 10 ticks and let the other one run. So your risk per trial on your $15,000 account, we said was going to be 2 lots times 12 ticks, or $240, divided by a $15,000 trading account. That gives you a risk per trade of 1.6%. Okay, so you come over here and your risk per trial is 1.6%. Now, here's one of the problems you automatically see. If you Google search what is a risk parameter, how much should I be losing or winning on, or sorry, losing or risking on a particular trade or a particular day? And kind of the industry standard is somewhere between 1 to 2% of your account in a given trade or a given day. Well, you can already see here that if you have a risk per trial of 1.6%, then if you take 2 trades and they both lose, then you've risked already more than what is considered to be suitable for most trading accounts. Now, we're going to add a commission in here of $5 per trial. Now, if you trade something else, this might be a low number for you. In the futures markets, commissions are going to be a little bit cheaper and you're going to get some slippage. So to account for slippage and commission, we're going to use $5 as a slippage and commission ratio in this algorithm. Okay, so we're going to come over here and I'm going to come back over here, and again I'm going to show you, this is where you're going to plug in all of the information. Okay, this is where you're going to plug in all of the information about what your system is doing, whether you're testing it or you're plugging in something actual. So remember what I told you is that for every time you win, you're going to win $160 on average, right? That's taking one off at 10 ticks and letting the other one run. So you're going to average about $160 per trade. Now we're going to divide that by the initial risk that we said was $240 was your stop. And that's going to give you 67 cents for every dollar that you put at risk. So we'll come back over here and we put that in at 67%. Now, I'm going to show you how a 60% win rate, which is decent, right? 60% win rate is decent. Trading these 2 lots at that reward to risk ratio is going to fare. Now, your losses when you lose, they're going to be 35% of the time. And because you're taking one off at 10 ticks or one off at $100, then your break even statistics are going to be lower. You're going to break even less time because you have a smaller target, right? You have a smaller initial target. So if you look down here at the bottom, there's 100 total trades being calculated, and that's what we said we were going to be looking at. Now, I'm going to hit reset, and then I'm going to hit start, and there's a couple things that I want you to look at over here, right? If you come in over here, you're risking 1.6% of your account. Your position size is $240, and you can use this for whatever dollar value per instrument that you're trading. And then there's going to be a couple things down here that I want you to watch. We're going to look at max drawdown. It's going to be something that we want to watch for here. So with all that being said, we're going to hit start, and we're going to hit run all trials. And what this is going to do is randomly distribute all of this information over the course of the spreadsheet, right? So what this says is that your first run through this, you had a $3,500 profit, okay? $3,500 profit with a 65% win rate on 2 lots. And your max drawdown in this scenario was 7.2%. That was your max drawdown in this particular scenario that's being run. Now, if you go down and scroll through this, what this does is this actually shows you on a trade-by-trade basis how you did. Here's the winners, here's the losers, et cetera, right? And it randomly distributes what that would have looked like if they were actually being traded. All right, so that's cut number 1. We'll hit start, reset. We'll hit run all trials, and this time with a 65% win rate and the random distribution, you made $2,300, okay? $2,356, and you had a max drawdown of 8.2%. 5.2%. All right, so we're going to run it again, and we're going to hit reset. We're going to hit start, and this is the last time we'll do this. We're going to click run all trials, and this time you had a loss of $810. Okay, your win rate this time was 60%. You guys already see a problem with this? Your max drawdown during this scenario was 8.8%, was 8% total, okay? So do you guys already see a problem with this? You had a 60% win rate and you had a you lost $810. So if you add the 3 months together, let's go back here and do this. Month number 1, okay, you made $3,500. Okay, month number 2, you made $2,356, and then month number 3, you lost $810. So a total over 3 months of $5,046. Okay, you had a max drawdown during that period of 8.2%. All right, so keep those numbers in mind as we go on. So now, what I'm going to do is show you how a one-lot trade at $100 of risk, okay? So we're going to take this down to $100 of risk. And on your $15,000 account, we're going to risk $100 on a one lot and divide that by $15,000. That gives you a risk per trade of 0.006666, right? So we'll come over here, we'll change this to 0.006666, repeating. That gives you a risk per trial of 0.67. Now, automatically, what do you see? We talked about 2% risk being what you want to do on any given trading day or trade, right? You don't want to risk more than 2% of your account. This gives you the opportunity to have lower risk amount and have 3 chances to lose on a day instead of 1, right? So this gives you the opportunity to stay within kind of industry norm risk parameters, same commission percentage, etc. Okay, now we're going to come back over here and remember those statistics that I showed you earlier. We're averaging at about a 2.5 to 1 reward to risk ratio. That was your winning trades versus your losing trades. 2.5% reward to risk ratio. We're going to plug in 35% wins. We're going to plug in 45% on the losses and 20% on your break evens. Remember, you're going to have more break even trades when the market goes down, doesn't quite hit your target of 2.5 to 1 or 3 to 1 or whatever you're targeting at that point. It's going to come back and take you out. Remember what I told you, what I'm going to show you today is hard. That's what makes this really hard, right? Is the market will go in your favor and then come back and take you out. But I'm going to show you statistically why we do it. We're going to hit reset. We're going to hit start. And here is your position size. It's $100. Your current equity is $15,000, and your risk per trade is 0.67%. So now we're going to come down through it here, and your winning percentage, you're winning 35% of your trades. We're going to click Run All Trials. And this time you had a profit on a one lot of 2407. Okay. Your win percentage was 32%. Okay. And your max drawdown here was 6%. Okay, so that's scenario number 1. All right, we'll run it again, reset, start. And again, remember when I run these averages are what they are over the course of time, but you know how averages work. Some months it's going to be a little higher, some months it's going to be a little lower. We're going to click Run All Trials again. And this time you had a profit of $770 with a win rate of 26%. And you won $770 after commission, etc. And your max drawdown was 7.4%. I'm going to show you why this particular number is impressive. All right, so we're going to hit reset. We're going to hit start. We're going to click Run All Trials. And this time your profit here was $39.65. $39.65, your win ratio was 35%, and your max drawdown was 3.7%. All right, so let's go back and calculate the totals here now. So your first month was 2407. Your second month was 770, and your third month was 3965. That means you made a total of 7142 with a max drawdown of 7.4% and a win ratio that averaged about 30%. So what I showed you originally here, you had a win ratio of the month that you went down below 65% on the win ratio, you lost money. You had a 26% win rate in the second go around with a higher reward to risk ratio, and you won money. So for me personally, and again, I'm going to tell you why this is really hard, and then I'm going to show you a study that we did. I'm going to tell you why this is really hard. This is really hard to go through and say to yourself, I'm going to have a 26% win rate, even though I know it's the best thing for me, because I'm getting out quickly when the trades aren't working. All of the vendors out there in the world, trading vendors out there in the world, want to tell you about a high win percentage, and that's great as long as the reward to risk ratio is in line. You can have a low winning percentage as long as your reward ratio is in line with what you are doing, right? And so for me personally, it's easier. It's a much more relieving kind of idea to say, you know what? And this is what Paul Tudor Jones said. He said, I can be a complete imbecile with a 5-to-1 reward to risk ratio and still not be wrong, right? And so trading is hard, and the variables that are out there are so different and difficult, and they could be, right? The variables are just unknown, and they're limitless. The variables are, right? And so the advantage of having a statistical edge is knowing what the score of the game is going to be before it ends. But it is not easy, and it is something that has to play out over the course of the long term. Now, I did this same idea that I showed you here, and I said, here is an all in versus all out, right? So all in, scale out, and all in, all out. And I did this spreadsheet, and I ran those numbers through this spreadsheet, and I did it over a 6-month window of time. And so what we basically did is I plugged in all of the numbers here, right? And I did an equity graph of each individual one of these, and everything in green is wins and everything in red is losses. And I did it for 6 months, okay? And so we said this is with 2 lots, trading $200 with a 62% win rate. And instead of the reward to risk ratio being 0.67, I bumped it up to a 10-tick stop, or 80 cents of win for every dollar you put at risk. And so if you come over here and you look at the beginning equity of $15,000 and you look at 6 months, the ending equity was $19,628. Which is good, right? By any account, if you can grow your trading account by 30% in 6 months, that's a good thing. But there are a couple of white knuckle rides in here that you need to be aware of. There's a 14% max drawdown. There's a 12.5% max drawdown. Those are white knuckle rides. And so what we did is we just said, here's your starting balance. Here is the ending balance at that month. And then we said, let's carry that over to the next month. And we just ran this through 6 months. So that is all in and scale out using that methodology that I just showed you, right? So if you're an all in scale out guy or gal, then these are the kinds of things that you could sort of expect depending on your statistics. Now, I ran the same thing with a 31% win rate using 1 lot and managing my risk to 2.5-to-1 reward to risk. Everything else being identical. Here's month 1 at $15,000, and here's the end at $30,500 using a 1 lot, 31% win rate. Now, here's the thing that I want to draw your attention to. There's not 1 month here where your max drawdown went over 6.7%. Your max drawdown never went over 6.7%. Remember, I showed you the max on the other side was 14%. So not only are you having to win at a high clip, but because of the way that it's randomly distributed, your drawdowns are going to be bigger because you have more risk, 2 lots versus 1, right? And so let's take a look at month 3. And this phenomenon occurs, if you've ever been to a trade room, you're going to understand what I'm about to show you. So again, all these statistics, there's month 2 and here's month 3, okay? And so here's the way it works with a trade room or a new trading system or something that you find that you like. Okay, so here's month 3. Whoops, make sure I got the right month here. Hang on just a second. I don't know if I do here. Hang on. Okay, yeah, this is month 3 right here. Okay, right, this is month 3. All right, so if I told you that you're going to have a $4,000 trading month using one lot, you would all tell me, I'm interested in that, Jason. I'm all about that. Okay. And if I told you that trade 224 through 233, which is 10 trades, okay, that's 10 trades, and you're going to have one losing trade, and you're going to average about $250 times 9 trades, you're going to average $2,250 during your 10 trade run. You would say, that's fantastic. And when people come to my trade room and they see this thing occur right here, everybody joins. But if I told you that your win percentage, and I didn't tell you anything else, if I told you your win percentage in month 3 was going to be 36%, and as you get to month 3, there's month 2, here's month 3. If I told you in month 3 that you're going to have a set of trades that goes like this, trade 255 to trade 280 is 35 trades. And in that 35 trade window, you're going to win 3 trades. You're going to have a 8.5% win rate during that series of trades. So if I told you you're going to win 36% of the time, and then there's going to be about 30 trades during the month that you're going to lose 92% of the trades, you would tell me, no, thank you. But if I told you you're going to win $4,500 and there's going to be a stretch where you're going to win 9 out of 10, you would say, I want to do it. Well, it's the same exact system. It's the same exact statistics randomly distributed out over the course of the month, right? And so here's what happens. You buy a new system, a new trading program, and this is what it does. And then you're happy and you talk to your wife and she finally let you buy something new and you're happy and you're all excited. And then you go here and you go through this run of negative and you all say, well, I knew it. It broke. It's not working. Or at a minimum, you begin to tweak it. You begin to say, well, if I just add this to it and that to it, then it'll be better. And I'll begin to filter it out and it'll be a better system. Well, all you've actually done is maybe not make it better, but actually just skewed the natural statistics because now the variables are different, right? And so that's just human nature, right? This is why it's hard, because it's all right here. When you go through this run, that's a very, very difficult thing psychologically to have to deal with. It's all easy when it's this, right? It's all easy when it's that run right there. Anyway, that's what makes this idea so challenging. And so remember the football game that I told you before, right? When I showed you before that you were losing all the way to the 4th quarter with 1 second left. And if you didn't know what your edge was or your psychological advantage, or you didn't know what the outcome of the game was going to be, you would have quit watching and moved on. But because you have a statistical advantage that is based in statistics, then you have a really good chance of hanging around with your system. That's what makes it difficult, right? That's the thing that makes it difficult. All right, so that is, let's keep going here. I've got about 9 minutes left here today. And so really, equity growth and the holy grail of trading is really all about proper risk management, what your win rate is, and your position sizing. And so what this spreadsheet that allows you to do in something like this allows you to do is you say, well, Jason, you know what? I can't handle a 25 or 30% win rate. That's not something that I can handle. I need to be better off. Well, okay, just understand that if you go for smaller targets, then your win rate's going to need to be higher. And remember what I just showed you. If you are less than 1-to-1 and you have a 60% win rate, then you're going to lose money. You have to be somewhere north of 65 to 70% to do that. So there's going to be a balancing act, right? And what I have found over the course of doing this is that there's a lot of traders that don't actually know what their statistics are. We all read about journaling and keeping track of our statistics and how that's important. This is why that idea is so important. All right, so again, equity growth is the holy grail of trading. The holy grail of trading to your equity growth is proper risk management, your win rate, and your position sizing. And so I told you at the end that I was going to not sell you anything. I was going to just offer you something. And here is what I am offering you today. We run a day trading chat room. We do calls and ideas and discuss these types of things every single day. There is a link in the main area there to register for a free trial. We open the doors on Monday morning. If you're there at 7:30 a.m., we actually start the audio portion at 7:45 a.m. And that's my presentation for you here today. So anyway, that is it for me. Let's see. I'll go through here and see if there's any questions. I don't see a lot of questions, right? I just gave a bunch of information here to you today. And so again, I appreciate you sitting in here. Hopefully you learned something. This is such an important component of trading that it doesn't get talked about a ton. There's lots of different, one of the things that we talk about in our trade room is that there are tons of different ways to get into and out of positions. And there are as many people out there doing it as there are ways to do it. But the most important thing in trading is how are you managing your risk once you're in that actual trade, right? And so we feel like that's kind of a unique way that we look at things in the world, and we do that every day in our trading chat room. And so again, I don't see a ton of questions, which is, well, hang on a second. You know what? Let me scroll down. Give me 1 second here. Let's see here. Okay, so here we go. It comes from trading, okay, on the CTA statement. Yeah, have to start with a lot of money so you can write out those losses. Well, you don't really necessarily have to, right? I just showed you, Dave, how you can have a $15,000 trading account as long as you're managing your risk, right? That's $15,000 by trading standards is not a ton of cash, right? If you do lots of big losses, yeah. What is the buy sell offset and the per trade fee? Well, as I showed you in that we did we added the commissions into that formula for commissions and slippage. The buy sell ratio is not important in this scenario, right? It's not about a particular system. It's about how you perform statistically all together. You could then break it out if you wanted to into your buy and sell ideas. And by the way, if you come to the trade room and you like what you see and you become a member, this spreadsheet is part of that program and part of the stuff that you get. So it's not really it's not on an individual trade basis. It's not on a buy or sell. You can break it down into that kind of process if you would like, but this is an aggregate or total of everything you're doing. Am I saying that people's stops are too large? No, I'm not making an evaluation on someone's stops. What I'm evaluating is you have to do whatever you do, okay? However it is that you trade, right? If you have a $200 stop or you have a $500 stop or a $1,000 stop, it has to be in line with what your account is. And if it's not, then you have a much smaller window or margin of error. And what most people don't realize is that they can trade smaller size on a smaller account and go for more if they know how to go for more and where it is to go for more. And we provide tools. It's just too long to kind of go through that whole process of the tools that we provide to do that. We have a trading chat room. We have a YouTube channel with 400 videos where we try to show you exactly how to hang on for targets like that and do those and accomplish those kinds of ideas. But at the end of the day, this isn't a judgment on what your particular style of trading is. This is just helping you understand what you are doing and how what you are doing will affect you in the bigger picture of things, right? Yeah, Jerry, if you want to send me an email, jason@mailotg.com, I could give you a super good deal and a couple other things. So jason@mailotg.com, Jerry, if you're interested in that. Wayne, I threw the link to the trade room in the main chat window area there, so you can do that. Yeah, and David says that's a ton of cash to him. And you know what? $15,000 is nothing to sneeze at, right? And so really, this model works. So one of the things that we do is we promote some of these prop firms like Top Step Trader and Earn to Trade, where we have successfully gone through their programs. So we've had over 3 dozen last year make it through the prop firm or Top Step Trader. That's what they preach. They preach to you risk management, risk control. This formula fits into that extremely well. Now, there's some tight parameters and some things like that. And this is a whole bigger discussion, but the risk side of this, and that's where if you don't have a ton of cash, you can go to a place like that. And I don't want to open up a whole can of worms about these prop firms and those kinds of things. But at the end of the day, there are parameters in here that you can actually do well and trade other people's money, right? I have a webinar where I just went through the Earn to Trade folks to test it out for our people. I show you where they deposited $5,000 directly into my account, and we go through a webinar about what they do and what they offer. And so there's a whole other thing that's just too broad to cover here today. What I really wanted to sink in here today is that it is possible to have low risk, trade a small account. As long as you're managing your risk properly, you can be okay. It sounds like you don't favor a scalping technique. Right now, I'm essentially trying to scalp ES. You know, I don't, again, it depends on how you're scalping, right? If you have a 4-tick stop and a 4-tick target, you just know that you have to win at a much higher clip in order to be successful. I'm not judging or evaluating that. I'm just showing you what works for me, right? But you just have to know that if you slip, like I went through, there's a website out there right now, and I've got about a minute left, so I'm gonna say this really quickly. There's a website out there right now that posts their trading results every single day. And when I went back and calculated them all up, they had an 80% win rate. That's fantastic. 80% win rate's fantastic. They made $5,500 last year trading 2 lots. And every time they dipped below about 70%, they had a losing month. So that's a lot of pressure to me to have to know that I have to win 70% of the time or greater in order to be successful. Knowing that I win 80% of the time, I made $5,500 on 2 lots, that's a lot of pressure. But that, I'm not judging whether or not that's just your personality. We all have this, we've all come to this thing together in different ways. All I'm trying to show you is that you have to just understand what your statistics are so that you know what your advantage is in the long term. How do I register for the 5-day trial? There's a link down there, Lawrence, in the area. Is the free trial opt in or opt out at the end? Yeah, it's free. And so you don't put a credit card in, you don't have to do anything. You don't like it, you just don't come back. It's just really easy, right? Yeah, that's right, David. Risk reward management goes with everything that you do. And I am out of time, guys. Thank you so much. I appreciate all the questions. I know this isn't the sexiest topic in the world, but I appreciate your time today and listening here.